Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Alan Patricof, investor and really one of the founding fathers of venture capital. Alan, great to see you.
Nice to be here with you, Andy.
So many different ventures in your long career, but I want to ask you about Primetime Partners first, which is your latest endeavor. It's about investing in companies that address the elderly market or the market for people who are a little bit older. How did you get into that? Maybe it's obvious, but what is it so appealing? What's so appealing about that business?
Well, it happened about 4 years ago. My wife at that time had been suffering from Alzheimer's for 12 years, and as a result, I was reading everything. I was going to conferences or reading books and all these people's prognostication about different diseases and about health. And I came to realize this was a very interesting market because by 2030 or thereabouts, there are going to be more people over 60 or 65 than there will be under 18. And I talked about it a lot, but I didn't do very much. And I was at that point thinking about phasing out of Greycroft and doing something else, my third act. And my son said to me that a woman named Abby Levy, who I had known very well because she was the founding president of Arianna Huffington's second company, Thrive Global, where I was an investor. The first company, I was Huffington Post, which I also was involved in. And he said, Abby, who had been his classmate, is focused on exactly what you're focused on. And she and I hadn't seen each other in a couple of years since she left Thrive. And he put us together in a matter of days. And a month later, we both shared this vision. Here was an underserved market. It was really, in a way, a white space. We said, older people, there are more of them. They have money. They're living longer. As I said in my book that I had just written, No Red Lights, which referred to how I lived my life and with no red lights, that I was going to live to 114. So it all kind of came together, and we said, let's start a fund. And we started a fund, and we went out to raise $50 million, which, it was a new area. At that time, there were 2 or 3 firms that were doing something similar. Today, there may be 7 or 8, which is approaching this older market, which needs everything.
Right. So have you deployed capital? Have you made investments? And
Oh, yeah, sure.
What are some of the investments you've made?
Yeah, we've deployed the entire first fund, almost including the reserves, in about 35 companies, and almost all of them were early stage, definitely, but startups, either starting up with our investment or in a year or 2 beforehand. And we've lost 4 of them, which is a very relatively small percentage of, you're in the startup business. 1, we got a return of capital, and we've had about 15 to 20 which have had significant markups, and the rest are carried at cost. And when you're in the startup world, it takes a long time to build a company, and it's like Michelangelo didn't paint the Sistine Chapel in a day. It takes 5 to 7 years for a young company to nurture, and we haven't been in an environment of IPOs or big mergers and acquisitions, and it's a new area. So we're very happy with where we're at, but nothing that we can shout home about. On the other hand, we've had at least 3 companies that have gotten past 50 million in annual recurring revenues, and we've done well enough that we just went out and started raising money for a second fund, which is going to be $60 million.
Are they healthcare companies specifically, or are they?
There are any companies that we invest in have products, services, and technologies that serve the elderly, let's say the over 55 audience. And there are all kinds of things, starting with caregiving, to telemedicine, to services to make your life more pleasant. One of the biggest problems for older people is loneliness. So how do you overcome that with services that connect them to a community? We have a company for that called Get Set Up. We have another company called Safe Ride, which does what is called NEMT, non-emergency medical transportation. not Uber or Lyft, and not an ambulance, but someone who picks up someone and for a medical appointment, make sure they get picked up on time, delivered to the right place on time, then picked up again and taken home, which is going through the roof. So we have a bunch of companies. None of them are household names, and I don't know if they ever will be. We'll see whether they're going to go public at some point. My guess is they're more logical that they're going to be acquisitions. We got a lot of product for companies that want to buy companies.
So you have all these decades of experience, Alan, and I'm curious, how do you identify a great company to invest in?
Boy, if I could give you a really clean answer on that one, Andy, you'd quit this job and go do something. So would I. I think it all starts out with having the right jockey, as they say. I mean, if you don't have the right person in leadership who motivates people, who understands the address market they're trying to serve, who doesn't understand the economics of how you make a profit in the business, and who can attract other people. I say one of the best tests of a young entrepreneur is, does anyone else join that person from a previous job? In which, what I mean there by that is we've invested with money, but they are investing with their career. So the fact that they don't do that unless they believe in the person, they believe in the idea and the economics, and they want to be part of it. And that has a lot to do with it. So I would say the jockey is most important, because the jockey, the CEO, the founder, if the product strategy doesn't work, he can change it or she can change it. Whereas if you have a product line or a service and the wrong leadership, they don't know what to do. They don't know how to pivot. So I've seen over the years that good, dynamic, charismatic individuals who've got it put together have a higher probability of success. That said, even the good ones fail.
Right. You mentioned that this is your third act, and you've had a couple of other big companies. You mentioned, or I should mention, Apex, Graycroft. You had whole careers at each of those places. Is there a narrative arc to all this, Alan?
And that's a really very fair question. Why did I leave these three, particularly in the case of Apex? It today manages $85 billion under management, which is you can imagine is a lot more lucrative than running a $50 million fund in partnership with someone. But Apex, when I started, it was Alan Patricof Associates. We added APA, we added an X when we got to 12 countries around the world. But we had morphed from a venture firm into a private equity firm. And the appetite of the other partners was more and more turning towards later stage deals, growth deals, buyouts, taking things private. And my juices get going with venture. And so I decided, it was also around the time of the bubble, 2000, 2002, that I would take some time off. And I was fortunate enough at that time to be friendly with Jim Wolfenson, who was running the World Bank. And I volunteered my services pro bono to help with their small and medium-sized enterprise activity around the world, mostly in Africa. And so I spent a few years traveling in Southeast Asia, as I say, mostly in Africa. And then I decided, it's time to go back in the venture business again. And I identified two new people, one on the West Coast and one on the East Coast. And we got set up in New York and Los Angeles, and set out to be an internet and media venture firm. How about that? Now we're focused on Primetime on older people. In 2006, it was internet and media. Today, I don't think if you started a fund that said internet and media, you'd have as much interest as there was at that time.
Yeah, let me follow up on that specific point, because you were a big-time media investor, invested in a bunch of companies that became very successful, some of them for a time, some of them sustainably. What is it about the landscape that's changed so much for media, and why is it so less appealing now?
I think the dependence on advertising is a big problem in the first place. And the second, audiences are being, widely distributed. They're going into social media. The retention rates are not as great. The print certainly has become so expensive. People can't afford to do it, so they've gone to digital versions. I mean, the New York Times is the best example of having gone from one level, just a print edition to a much, much more varied company today, including puzzles. And so is the Wall Street Journal. I mean, they have built an online reception. And I think, you just look at the record, it's been pretty bad for early startups. We had at Greycroft one of the most successful media companies, which I was on the board of, which was Axios. But that's more an online newsletter, not in the old tradition. I think for someone to start up a print version or a company depending on purely advertising today is a difficult problem.
Yeah. You mentioned you find venture so appealing as opposed to other forms of investing.
Yeah, I like to suffer.
Well, yeah. Why is it? Because you're a masochist?
Yeah, I think so. Well, in the 99, 2000, 2001, as I like to say, there was at least one company in our portfolio every week that couldn't meet Friday's payroll, which was pretty rough. We haven't seen that really. I have to say I haven't seen that at all in the last 4 years. I mean, companies need to do financings and they can run out of money, but somehow companies seem to be better prepared. So it's been a less crisis-oriented scene. But I get more satisfaction out of having been involved, no matter what the involvement was. The companies I've been involved with, like Apple and America Online and Audible, that stays with you, as opposed to in the private equity world or the growth world. You invest. It's a trading sardine as opposed to an eating sardine, and there are still a lot of companies around that I was involved with that are still here, are much, much, much bigger. In fact, the first company I invested in 1970, which wouldn't have a chance of raising money today, was a secondary lead smelting business, which set out to develop plants that were environmentally sensitive. In 1970, this was really ahead of EPA and everything, but you could see the trends coming. And that company today is a several billion-dollar company, private. Went public, went private. But in the 1970s, you didn't have a lot of companies to choose from. It was a new industry, and the phones weren't ringing every day with people who had, and there was no internet, sending you their proposals. Today, at Primetime, which is a small firm, relatively, 4 years old, we see at least, I think we record 600 deals a year of proposals.
Right. I mean, that sort of leads to this next question. A lot of people are suggesting there's too much money in venture, and there is a lot of money in venture capital today. But on the other hand, you seem to be saying there's more startups than ever. There's more people looking for funding. So how do you think of this balance or lack of balance between the two?
Well, I can respond to that. First of all, I don't think that from a political standpoint, no matter who is president, has any impact. Entrepreneurial activity has a sense of vitality and energy level that doesn't get thwarted by politics or inflation or interest rates. People have ideas, they want to execute them, they get excited, and they're believers. I think that your answer to your question is that a lot of the excess that's come into the venture business has been from people who've gone down market, from the hedge funds, from the growth equity firms, from the buyout firms who dabbled in venture and, in my opinion, ended up creating pricing levels for not the earliest stage, but in the follow-ons that affected valuations enormously during 2021 and 22. And we've spent the last year kind of getting down to basics, and companies have had to do follow-on financings at the prices they did 2 years ago, which means that today they may be worth what they were priced at 2 years ago if they're still around and functioning. And I think there's less of that later stage money coming into our market. Valuations have come down. A flat round is the new up round, and a round down 20% is pretty satisfactory if the company's making progress. So I think reality is set back in, and I don't think there is too much money coming into venture at the moment. Now, in my area in particular, I mean, we have tremendous opportunities now. They're not all very good. I mean, I say we see 600 a year. We'll probably invest in 10 companies. So, and we're not the only ones.
Yeah, that's a lot of work from going 600 to 10.
Part of the business.
But so speaking of politics, I mean, so you don't think Donald Trump is going to have any particular influence on the venture business, or what's your take on that, and maybe his influence on the economy writ large?
Well, in terms of venture, he has spoken out and said he's supportive of small companies. Elon Musk has said the same thing, and the people around him. So an atmosphere and environment is very important. So I hope that it is going to be a positive environment. I think that I'm concerned about reemergence of inflation if we see a lot of these tax cuts that have been proposed, and I am concerned with income inequality, and I'm worried about the middle class and getting their share of the prosperity we have. So certain things, cause me some concern, but I think that venture is going to do well. I think the one unknown is the IPO market. The IPO market, at the end of the day, does feed venture because it's the way of exiting, in addition to, of course, M&A. And I think that if we see a reemergence of the IPO market, a lot of people will get liquidity. When they get liquidity, they have more money to reinvest, whether it's institutions or the funds themselves. And I'm hopeful, but we've had a real dearth of small companies. I mean, Andy, you don't go back as far as I do, but I remember when you could go public with a company that had a valuation of 10 or 20 million and raised $2 million, and you had all the retail market. Today, you've got a institutional market in the public markets, and they need big companies that raise big amounts of money to justify underwriters taking them public. And so that means the whole young company, startup, early stage, is going to have to stay private longer to build it to a level where it can justify possibly an IPO, or in the meantime, an M&A transaction.
Shifting gears a little bit to you, Alan, you recently turned 90 years old. Happy birthday to you.
Believe it or not.
Yeah, I believe it. And, I know you get asked this all the time, but I have to ask you, what keeps you going, man?
What keeps me going is I start out every day with a positive attitude. I only know the word yes. No is not part of my vocabulary. I don't get depressed. I know that's strange, but I just has not been part of my life. I work full time. I have a trainer 3 times a week, and I walk 5 days a week with my new bride. We put in 3 or 4 miles a day during the week, and 5 to 8 miles in the weekend. Not specifically, but about that. And I have a habit of weighing myself every morning and every night, and if I pick up more than 3 pounds, I cut out a meal the next day. So from a weight standpoint and health, I'm in good shape. And I'm in a world of technology and new developments. I say it in my book, and I've said it for so many years. I guess the reason I go to work in the venture business is every day I go to the reception area, and I hope the elevator door is going to open and the next Steve Jobs is going to walk out. Hasn't happened yet, but I think venture capitalists have to be curious. They have to have a positive attitude about things, and they can't be discouraged. If you get, we're gonna. It's a business where you got to be able to face problems and challenges and come up with solutions. And I don't know. I intend to keep doing this for as long as, I don't know, about to 114, but certainly through Fund 2 of Primetime Partners.
And you ran a marathon, the New York City Marathon, what, 2 years ago?
Yeah, at age 88, I was
What
the
was that
oldest.
like?
Tiring. It was not easy, and I almost didn't make it. I kind of had my problems at the 20th mile, but I was fortunate that by the 22nd mile, my cramping went away, and I was able to make the last 4 miles with a little bit of assistance from my youngest son, who's not that young. And I was determined. It's like anything else. I don't like being a loser. I want to be a winner. I intended to do it this year, but I unfortunately had a minor accident of breaking my femur about 4 or 5 weeks ago, and that put me out of the possibilities. And I don't run the marathon. I walk and jog it. I don't want to overstate it.
That's remarkable.
But just finishing is and by the way, the year I did it, I also went to Burning Man, which was a shocker for a lot of people. And I don't know what mountain I'm going to climb this year or next year. I don't mean literally a mountain, but what challenge? If you come up with a good idea, I might join you.
Send in an Alan. And final question, and you maybe have touched on this a little bit, Alan, but what is your advice for people, say, in their 60s like me, or 50s, 30s, 40s, 70s, who want to keep working and keep living for a very long time?
I love that question, because I didn't get a chance to say that in addition to products and technologies and services, we didn't put it up as a sign in the front door, but we in effect said, if you're over 55, you can apply to get financing here. And I don't think you'll find many reception rooms at venture firms where you'll find older people, because there's a sense that someone's got to be in their 20s in order to really have the energy level and the smarts to do it, and the technology know-how. It's been shown, by the way, that the most successful entrepreneurs are over the 40s. And that's been by studies done by people other than me. I didn't do it. So I would urge anybody who's listening or watching or talking about this, if he can do it, I can do it. And I set out to write my book, and I particularly was to be an inspiration to older people to say, why if 60, if I'm going to live to 114, I've only lived half my life. What am I going to do with the second half of my life? And by the way, society has to worry about that, because what are we going to do when we have, 10, 15,000 people a year retiring from General Motors, IBM, Intel, for all I know? Are they going to stay there? What are you going to do with them? How are you going to get them to train the next generation? How are you going to help them with their next phase of their life? So I think that people will be living longer and healthier, and therefore they will need things to do, whether it's social aspects or it's starting another career. If you've been in the paint business, start another paint company. You got the biggest Rolodex, the most people, you have most knowledge of how to mix colors and how to, the problems you can face. So do the same thing another time, or try something new and be an entrepreneur. And we're in a world of AI, and lots of things are going to be possible for people who have the energy to do it.
Amazing stuff. Alan Patricof, thank you so much for joining us.
Thank you for inviting me.
This is At Barrons. I'm Andy Serwer. We'll catch you next time.